Well, hello everyone, and thank you for joining me for Arizona Investor's weekly webinar called It's Your Money. My name is Travis Cadman, and I'll be your host, and today we will be talking about investing in real estate with your money. Firstly, I want to thank everybody for joining me on this Saturday morning, and if you are from Eastern Canada, good afternoon. Today's webinar should run approximately 45 to 50 minutes in length, and due to the audience that we have today, we'll be muting everybody. However, you can for sure ask me any questions you have through the course of this webinar presentation, and you can do so by typing your question to me in the text box located on the bottom right-hand side of your screen. How about everybody just gives me a little test right now and give me a little hello text if you can, if you want to test it out, just to make sure you know how to use the text box. So if you just type your hello in the text box and press send, we can just make sure that it works. Arizona Investor is one of Canada's largest wholesale ownership real estate investment companies, and we assist investors such as yourselves to get into real estate in some of the strongest real estate markets in North America with a true turnkey system that leaves really the daily work to us and the easy work for you, and we call this our turnkey system. Most investors like the return of real estate, and they like the returns that they provide. However, they do not know how to go about getting started and find the properties, deal with property management, handle repairs, property management, and this is really why Arizona Investor exists. Welcome to our full turnkey real estate investing system, which provide all of our investors the services that we offer, such as market research analysis, detailed property selection, renovations, cross-border taxation, Canada and U.S. mortgage lending, property management, insurance, foreign currency exchange, and investor reporting. Our corporate structure is made up of a number of executives that have been in the real estate industry for a number of years. Myself and my brother Ron have been in the real estate industry for 28 years. We have physical offices in Calgary and Phoenix. Our core business focuses on providing Canadian investors turnkey real estate investments in both Canada and the U.S. We have deployed just over $25 million to the single-family home asset class. Our property management company has just over 1,500 homes under management, and our current vacancy rate sits at 2.75%. The retiring population today, they're really concerned, I think, about how their investments have performed over the years. You know, I think a lot of the investors have been investing in stocks, bonds, mutual funds, all three which have truly underperformed expectations. You know, if we look at stocks, you know, really the value of stocks is back to where it was in the year 2000. So they've gone for the last 12 years and really made no money on their stocks. And as a matter of fact, they've gone behind when you actually take into consideration inflation. And you know, stocks is really fueled by emotions, when really, from our philosophies, we're principle-based investors, focus on baseline fundamentals to support our investment strategies. Bonds really haven't been producing what the investors expected them to produce and what the promoters said they would produce. And mutual funds, in our opinion, is simply a broken system and doesn't work. So investors today, especially the retiring population, are pretty concerned about what's happening with their retirement money, and most are pretty concerned about having enough money to live their years. You know, our goal and our objective is really to put your money to work in more ways than one, and I think it's a proven fact that more wealth has been created through real estate than any other form of investment. For the average Canadian retiring today, it is clearly evident that the majority of their net worth is comprised of real estate, and most of this net worth is in their own principal residence. So really what we've done is taken this basic principle of real estate investing and created a hassle-free system and a process that we call our turnkey system, and made this available for our Canadian investors. We're going to focus our conversation today in a market that we researched heavily, and that's Phoenix, Arizona. And you know, as Canadians, we see Arizona as being a snowbird destination, when in reality, the average age in the greater Phoenix area is about 35.4 years old. But us as Canadians, you know, we see it as it has great weather, lots of things to do, whether it be golfing, entertainment, shopping, great food, and just simply a great place to be. And you know, Phoenix itself has about 330 days of sunshine throughout the year, and it's just simply a great place to go to vacation and be a snowbird. But really what drives the Phoenix marketplace is its own fundamentals that rest behind it. And we'll talk about that a little bit through the course of this presentation. The opportunity that we see right now is really favored in the Phoenix marketplace. The Phoenix housing market is extremely overcorrected. Homes are well below replacement cost. The market has bottomed under the price of $200,000, and that's clearly evidenced by the statistics that we see coming through on the MLS, as well as what we see for the foreclosure notices, as well as current foreclosures going through the trustee auction sales. Now, for a house that's over $500,000, there's still more room, we feel, to drop there, and that is still a buyer's market, just because there's too much inventory in the marketplace. Obviously, we've got a strong Canadian dollar, low interest rates, strong and growing rental market, and banks aren't extending credit easily to Americans, and obviously this reduces the risk of similar inflated bubble qualified loans. Arizona is also a landlord state, and it's a pro-business state, so that favors investment for investors. And all this is on the back of what we call the financial crisis, which really was a hot housing market that cooled in 2006. It was really spurred by the creation of the subprime mortgage with all their exotic loans. Property values in some markets plummeted just huge, and in some markets such as Phoenix, we saw about a 65 to 70% drop from peak. And all this was on the back of the toxic loans. And some of those loans had 50-year terms, ARMs, which is adjustable rate mortgages, interest-only loans, and in some cases they had loans that was plus your financial costs. So you can get 100% financing plus your closing costs included in the loan price. So essentially you had 105% loan to value. This obviously created a huge buying spree and really a steep run-up in prices. And what that created in 2006, when a lot of these mortgages came up for reset, is the buyers, whether it be a homeowner or an investor, simply couldn't hang on to the mortgage because in a lot of cases their mortgage doubled or tripled in their monthly payments. So this created a surplus of inventory starting in 2006, and it was really on the back of highly leveraged buyers. Loan defaults went through the roof, of course, because of all this, and caused a major distressed real estate market where you had more supply than demand. And because there was so much inventory that got foreclosed on, it really created an overcorrected market and a great opportunity for investors to step in. When we evaluated the markets and we evaluated where's the greatest opportunity to participate in this unprecedented time, we looked at Florida, Nevada, California, and Arizona. And what our research told us is it told us that Florida was a great market to get into investment properties at undervalued price, good cash-on-cash returns, but it just wasn't as good as what it would be in Arizona because as a Canadian, we're penalized to invest in the Florida marketplace because as a foreign investor, we're going to pay more in property tax, and also their insurance costs overall is more money because of the hurricanes and tornadoes that go through that marketplace. So the net ROI for our investors didn't meet our expectations. Nevada, we feel, is a strong market. The only problem with Nevada is we couldn't get the fundamentals behind the recovery analysis for price appreciation. We had some cash-on-cash returns, which was good, but we couldn't see get the fundamentals behind the appreciation because it's not as fundamentally diverse as, say, Arizona. Nevada's primary income stream is through gaming and tourism and distribution. California failed for us simply because the prices were too high, even though there was what we felt there were some good deals on properties. We just couldn't get the cash-on-cash returns for our investors simply because the prices in California were still too high. And then, of course, with the state deficit, we feel there's going to be an increase in the investors and homeowners and their property taxes, and therefore that market failed for us. Arizona was the market of choice for us primarily because the fundamentals support it, and those are principle-based fundamentals. And we'll talk about a few of those as we go through the course of this presentation. This is our market recovery analysis. This is an important slide because it tells us where were prices. So if we look at this white line here, this white line kind of tells us where was the average price of a single-family home. And you can see the years 1990 through to 2003. This is what we call a normalized market. This is where you'll typically see real estate appreciation between the 4 to 5% range. You can see here with the creation in 2003, 2004 of the subprime mortgage, where pretty much anybody could get a loan. We always joked and said it was the type of mortgage where if you could fog a mirror, congratulations, you got a loan. And so you can imagine what that did to the inventory both of existing homes and new homes, where everybody could get a mortgage. Of course, everybody thought, well, I'm going to buy a house. So it put a lot of pressure on the housing stock, and with supply and demand forces coming into play, prices really just started to shoot up through the years of 2003, 2004, all the way up to 2006 when it peaked. Well, what happened when it peaked is the mortgages that were issued in 2003, 2004 started to reset. The subprime mortgage had a trigger in it that the mortgages that were issued, say in 2003, and they had a 3-year reset, they reset here in 2006. And when we talk about a subprime mortgage, it means that the mortgage was issued at subprime rates. So basically, T's are interest rates. So when they reset, and say somebody had a mortgage at 2.5%, but when it reset to 6 or 7%. Well, you can imagine somebody's monthly payment going from $1,000 a month to $3,000 a month. So what happened when that occurred is investors and homeowners, instead of mailing in checks, they mailed in keys. And it just didn't happen by 10 or 20 houses. It was actually by the hundreds and then by the thousands, and then caused a subsequent decline in housing values because all of these homes that had these subprime mortgages started to get foreclosed on. So what you had is you had the reverse of what happened in 2003. You had excess inventory hitting the marketplace, and then you had a declining real estate market. And in a declining real estate market, people are skeptical to jump in because prices are falling, and that's exactly what it did all the way up until April 2009 when the average price actually bottomed in April of 2009. So this white line kind of tells us where prices have been and where are we today. Right now, today, we're bouncing along the bottom, and we're just coming out of the bottom end of the curve. And it's clearly evidenced with the amount of the decrease in the amount of foreclosure notices going out, the decrease of the MLS listings. The balanced market on the MLS in Phoenix is about 35,000 listings, and right now we're sitting at about 18,000 active listings, of which 7,000 of those is actually pending. So it's actually going to turn into a seller's market here pretty quick. This green line here, this is our normalized trend line. So if there was no boom, bust cycle, we think that everything would just kind of continue along. Sure, there might be little dips, but nothing like we've seen. And this is really where prices should be based on supply and demand and construction costs. So with prices being way overcorrected and way below where they should be, now's a great opportunity to step in for a couple reasons. One is you've got a completely overcorrected market. Prices of houses are about 50 to 60% of replacement cost, and we're investing in one of the strongest growth markets in North America. So what will happen, in our opinion, is we're going to have a gradual accelerated pull-up to the normalized trend line where prices actually should be. And so you can see right now we're in an extremely overcorrected market and a great opportunity to step in at the bottom of the single-family home market, and the asset class is under $150,000. If we take a look at why real estate, say, versus stocks, bonds, and mutual funds, because the typical investor, they invest in stocks, bonds, and mutual funds. The reason why is because they're trained and they're educated to invest in that, because a typical investor, they go see their financial planner, they go to the bank, and they get them into stocks, bonds, and mutual funds. And that's really what they do. What's happened is these investments, historically, they haven't performed to the way that they should, and a lot of it is driven by emotion and not principle-based investments. If we take a look at common stock versus real estate, and let's just take a look at some of the differences between common stock versus rental real estate ownership. Let's take a look at if somebody invested $100,000 in a stock versus $100,000 in a real estate-based investment. First of all, the nature of the asset. With a common stock, of course, you'd get a stock certificate. With real estate, you actually get title to a hard, tangible asset. No different than you would have on maybe your own principal residence. The value of the asset controlled with a common stock, you could go up to $200,000. You could get a kind of a 2-to-1 leverage, but it's very in rare circumstances that you would get that. With real estate, you could actually use that $100,000 and use leverage and get up to $1 million and beyond, depending on the loan type that you had. So real estate, banks love real estate, and they lend us money to buy real estate. And even in the U.S. right now, we have U.S. lenders that are lending to Canadians to buy real estate. So when you can use other people's money to assist you in gaining a hard, tangible asset, that's a good thing. The purchase price for a common stock, you'll typically always pay market price. With real estate, found and bought typically at under market values in distressed areas, and that's what we're talking about here in the Phoenix, Arizona market. The market efficiency with stocks we feel is supreme. Everybody pays the same price for a given stock. The market efficiency in real estate is quite low, actually, varying opinions of sellers and appraisers as far as the values go. Potential for value improvement, really with stocks, none. You just got to pray that they go up and hope the promoters can push that stock value up, even though you paid a full-on retail price today. With real estate, actually, you got the opportunity to improve the asset yourself. Whether you renovate it, you do some refurbishings, you get a change of use. There's a number of things that you could do. We're going to talk about that in a couple of slides later. And of course, those are 100% deductible or depreciable off your income, so you don't have to pay, you can pay less tax because you can depreciate down your assets. When can appreciation be? When can you get appreciation? With a common stock, only upon sale. So you actually have to sell your stocks in order to get some money out of it or get some profit out of it, unless it's a dividend-paying stock. And with real estate, really you can get money out of it at any point from releveraging, refinancing, or a sale. So how great is that when you can own an appreciating asset, and if you want money out of it, you simply refinance it or re-leverage it and pull money out, and you still own the asset, so you can keep that money tree growing for you. Cash flow during the holding period, typically with stocks they would do small dividends, and that's if you're lucky. And of course with real estate you get income from the rental, and of course food, clothing, and shelters are rental properties, one of the key essentials of life. So you'll have a constant stream of rental coming in from our rental program. Depreciation really with stocks, zero. And depreciation we'll talk a little bit later in the presentation, but you're allowed to depreciate down your hard tangible asset, and with stocks you don't get that. But with real estate, yes, you can depreciate it over your properties and your chattels through the course of its accounting life, which is about 27.5 years. Inflation protection, really with a common stock, you don't really have much for inflation protection. You'll actually erode your dollar. And with real estate, both rental income and sales prices are indexed to current market values. So a hard tangible asset such as real estate is a hedge against inflation. And it's one of the reasons why we see more and more of our investors coming to us and investing in real estate. Return upon any sale, of course with the common stock, it's actual stock value. And of course with a return upon sale with real estate, you're going to have compounding appreciation up to $1 million or more, plus your improvements, plus any rental income, less any expenses, less any depreciation, plus any additional tax deductions, and hold for 365 days for a profit tax at capital gains rates versus straight income rates. So when we look at a common stock versus investing in real estate, there's some really key fundamental differences that you need to look at that I think, in our opinion, really favor real estate investing. And you know the problem's been with investors. They've always had a hard time getting into whole ownership real estate investments. Sure, people can invest into a REIT, but you're paying retail top dollar for the REIT values, for the unit values or share values at that time. But real estate was always difficult for them to get into until now with our turnkey real estate investment system. Other reasons to consider Arizona, it's a lien theory state. And what that means is, it means that Arizona is a trustee state, not a judicial state, such as California or Florida would be. And actually Alberta, for people that are in Alberta, that would be more of a lien theory, it would be more of a judicial state, because houses in Alberta need to go through a judicial sale process, as they do in a lot of provinces in Canada. In Arizona, it's a trustee sale process. So the process to foreclose on a home is actually handled by the bank, and the bank retains the trustee, and the trustee goes ahead and forecloses on the home. And it's just a much quicker process. To give you an example as to how that works for a house going through foreclosure, it takes about 120 days to 150 days to move it through the foreclosure process with the lien theory state through the trustee sale, versus say a judicial state where it's got to go through the courts. It can take up to 250 days. The other thing that's happening in Arizona right now is the shadow inventory in Phoenix is dissipating. We see that our foreclosure notices are down about 64% from where they were at the peak in 2009. It's a non-deficiency state, so owners decide to walk, creating a strong rental market. It's good for investors. So it's a non-deficiency state, meaning that the banks can't go after the borrower for anything other than the asset. And sure, they can scrap their credit report, but they can't attach it on to the other assets that the borrower may have. The economic indicators that we have a lot of detailed data on, and we also do webinars on. The economic indicators say this is a buy market for our investors now, and it's a very strong buy market. This map shows the 2020 population projection growth, and it's actually noted that the U.S. Census Bureau is projecting Phoenix, Arizona to be in the top 3 growth states between 2012 and 2020, and it has always been a very strong growth state. And as real estate investors, we like strong population growth, and we like strong job growth. There's major employers that are located in Phoenix. As you can see from the map here, there's just many, many major Fortune 500 and 1,000 employers that's in the market. That's primarily driven because the state and the city is a pro-business government, both at the state and the city of Phoenix level. There's an affordable business climate. There's low corporate tax. There's no franchise tax. The laws favor business. There's no franchise tax. Housing is affordable, and we have great transportation network, and it has just many, many lifestyle benefits that would favor corporations and their employees to locate there. The greater Phoenix area is comprised of about 4.5 million people, and there's about 5.8 million people in the state. Phoenix itself is about 1.5 million people. So if you look at the map here, you can see this is the area of Phoenix here, and then of course to the west we've got Glendale, Avondale, and Goodyear, and to the southeast we have Mesa, Gilbert, Chandler, and down here further is the further southeast, which is Queen Creek and Santan Valley and Johnson Ranch. The highlighted areas here that we see that are kind of highlighted, these are our buy areas. This is where we're currently aggressively buying inventory for our Canadian investors through the Arizona InvestR program. What we've done is we've looked at the entire database. Obviously, we have a large database to draw from for historical rental demands. We overlaid that against a third-party analysis that we had done that defined the markets in the Valley of Phoenix that appreciated the most in the shortest period of time for the last 3 recessionary downturns. We overlaid that data over top of our rental data, so it told us specific zip codes that were the hottest areas and have the strongest fundamentals. So we've identified exactly where to buy our investment properties for both cash-on-cash returns as well as the real estate appreciation. We're not buying into certain areas such as Scottsdale simply because the price of the properties is too high, and that obviously has a negative effect on our cash-on-cash returns. Real estate makes you money in a number of different ways, and we're going to go into the next few slides and we're going to talk about exactly what are those ways that real estate can produce income for our investors. And of course the first one is cash flow, and all of our properties, as far as the baseline fundamental, we always look for positive cash flow. And I know back in the day when markets were starting to run up, people said, I don't really care so much about cash flow, I'm just after the appreciation. That's the wrong investment attitude as far as we're concerned, because if anything ever happened, it's always going to go back to, do you have a positive cash flowing asset? Because in our mind, that's the only way you're going to have a sustainable investment. So cash flow is obviously one way you make money. Tax advantages, we'll talk about that. There's some great tax advantages that's offered to a real estate investor that you don't get through traditional investing in things like stocks, bonds, and mutual funds. We'll talk about market appreciation, the effect that's going to have on your investment. We'll talk about forced appreciation, things you can do to just force the appreciation. We'll talk a little bit about principal pay down, and then we'll talk a little bit about the last leg, which is refinance. But let's take a peek at the cash flow side of things and see exactly what do we mean when we say cash flow from our rental properties. Let me give you a live example of one of our properties. So we talk about cash flow. Rental income less expenses equals typically your net monthly cash flow. So here's a property that we've got right now that's in inventory. The income is $1,200 a month. The expenses, which would include things like property management, insurance, property taxes, that would be $237 a month, leaving you a net operating income of $963. And if you put financing on this asset, say a 65% loan-to-value mortgage, and that would typically be in this house $488 a month for the mortgage payment, that would leave you a net monthly cash flow of $500 or $475. So we talk about positive cash flow. It's really important that when we invest always looking for positive cash flow. The next thing is tax advantages. There's very few asset classes you can invest in that will give you the tax advantages that real estate offers. And the first one that I like to talk about is depreciation. I've always said this is the phantom tax deduction. Because your rental property is used but not consumed as part of doing business, the IRS and also Revenue Canada allows us to deduct a portion of its cost over each year of its useful life. And right now, the useful life is determined at being 27.5 years from the date you acquired the asset, which means basically you can claim a 127.5 of the cost of the building and improvements each year. Now things like you can't depreciate your land, but your actual house. So separating the value of your home. So if you bought a house for $100,000, it'd be important to separate how much of that $100,000 is land and how much of that is the house. So let's say that your land was $25,000 and your house was $75,000. You would depreciate down the $75,000 over the course of 27.5 years. And what that allows you to do is it allows you to reduce your positive income down lower so you pay less tax. And based on our analysis for a lot of our investors and what's been happening over the last few years is they actually don't pay much tax at all over the first 3 years because we're using the power of the phantom tax known as depreciation. The other thing I'll tell you too is you can get some accelerated depreciation on things such as your chattels. So that would be like your stove, your fridge, your dishwasher. You're allowed to get a little bit of an accelerated depreciation in order to make that work. The other thing I'm going to talk to you about is known as the 1031 exchange. And here in Canada, you might not know what a 1031 exchange is because this mechanism isn't available for us in Canada. But really what it means is it means that you can actually buy a property, say for $100,000. You could sell that property for $130,000, say in 5 years. I'll just use that as an example. And say you have a $30,000 capital gain. Well, what you would do is you would enter in the transaction into what's known as a qualified intermediary. And this is a specialist that's qualified to do this. So you would enter in your transaction with a qualified intermediary, and you would buy another asset of like kind, so in real estate, and you wouldn't have to pay the tax on the $30,000. So you could actually roll your entire profit without paying tax, so long as you put that money back into a like asset, such as investment real estate, within the required time frame. Now, there's a note that I want to make here, especially because I'm talking to a lot of Canadians today. There's a note that I want to make is that if you hold this in your personal name, you're not eligible to utilize the 1031 exchange. It has to be held within a Canadian or within an American corporate identity. So, of course, that's the 1031 exchange. And I want you to know things as we go through our education process and our webinars. I want you to know things, even if it might not directly apply to you. I just want you to know about it so that you're aware that it exists. And so that's called the 1031 exchange or a like-kind exchange, and it's only available in the U.S. Talk a little bit about market appreciation. Of course, over the past 30 years, real estate has appreciated at about an average rate of 4.2% unlevered, which means that historically real estate values have increased. Well-selected real estate and well-timed markets can provide an investor a great opportunity to achieve accelerated appreciation. So well-selected and well-timed, and I think that's really what we're talking about here in the Phoenix marketplaces. We're talking about an opportunity where we could get accelerated appreciation because the market is so far undervalued. Straight line appreciation, let's just take a look at this and see how it looks. Say a normalized trend price of a house was $174,000, but because today's undervalued, overcorrected price, you could get that house for $103,000. Your market timing advantage would be $71,335. A note on this would be your net worth just increased by $71,335, and no taxes payable on that until the point in time that you sell it. And if you used an American Identity Corporation, utilize the 1031 exchange, you wouldn't have to pay tax. So market appreciation is definitely a driver in real estate investing. That's one of the reasons why we like investing. And when you use leverage, and if you use proper leverage in most cases, you can really magnify that return. Forced appreciation, a little bit different. Forced appreciation would be where you can actually do something to the asset to increase its value. An example of that would be if you did things such as replace the flooring, upgraded the cabinets, even painted the property, did some exterior improvements, maybe fixed up the outside, maybe fixed up the landscaping. What if you added a basement suite to your house? So long as legally it was conducive, but if you added a basement suite to your house, you added another income stream to the house, what did you do? Ultimately what you've done is you have increased its value. Another way this isn't used as common by our investors, but some have definitely used it, and that would be change of use, where if you bought a property that was in maybe a future area where there could be a commercial zoning, so you could change the use from a residential zoning to a commercial zoning, therefore have the possibility to increase the value of your property. But that'd be a very specific purchase that was done, and that would be in mind when you actually made the purchase versus it just happened by default. The other one, of course, is straight refinance. What if I just refinance my property? And, of course, that's one of the great things with real estate is you don't have to necessarily sell your property to pull money out of it. You could do simply a refinance. So let's take a look at what this means. Let's say that in 2012 you bought a property for $100,000. The value is $100,000. You paid $100,000. You put $35,000 down, and you had $65,000 or 65% financing. And say in 2015, you said, I want to get some money out of that property. And the value at that time was $150,000. Well, you could actually get a new mortgage, in this case, still using the 65% loan to value, and you could get a new mortgage, say, of $97,500, and just pull out $32,500 in cash. And do you think maybe that'd be a good idea to maybe roll that into another property and repeat this cycle, and build up a portfolio of properties where you just had this infinite money stream? And that's really what Arizona Investor is about as far as investors, is creating what we call an infinite money stream. And that's where you keep these properties, you don't sell them, and they'll just be a money-generating system for life and something you can pass on to the heirs of your estates. And if you did this, say, every 3 to 5 years, it'd be a way that you can get additional cash flow up and above the positive cash flow coming out of your house, and really take advantage of the benefits of investing in real estate. So that's just a quick example of a refinance. Let's take a quick look at principal paydown. And principal paydown is one of the beauties of rental ownership, or another one of the beauties of it, is that if you had an amortized mortgage, which means that when you made your mortgage payment, part of that was going to principal paydown, and part of that, of course, was going to interest. And as renters pay you, and you pay the bank, your loan balance gets reduced over the course of time. So let's say that you purchased a property in 2012, and you held that property with current lending terms, and let's say that you held that for, so say you held it for 10 years. Well, if your initial mortgage amount was $76,000, the total gross rent paid was $151,257. The end mortgage balance, in this case, would be $65,972, and this is based on current lending rates that's available in the U.S. right now for Canadians. Your principal paydown of that would be $10,028. How our properties produce income and create wealth for our investors. Here's just some of the things that we do to assist our investors to achieve their goals. The first thing is market research and due diligence to define the best cities in the asset classes to place capital. And right now we say that's Phoenix, Arizona. And we're active in Canada, we're active in the U.S., but right now the market for us to place capital with our entire turnkey system is Phoenix, Arizona. We provide market research and analysis for our investors. It's a different webinar setup and different seminar setup than, say, the one that we're on now. But our research, both internal and third party, definitely tells us that that is the market to place capital. We have a team of industry professionals that we've assembled to assist our investors. We have a system track that we've established with complete communication protocol. Investor turnkey model is deployed, property performance is achieved, and investor portfolio growth would be achieved as well. We've always said that well-selected and time cash flowing real estate has always outperformed the typical stock, bond, and mutual fund investments. And that's really what our system is geared to do for our investors. Let's take a look at, let's view a real action plan in action. So let's take a look at, a lot of our investors are buy multiple properties. And here's how a lot of our investors make that happen. And say on a 5-year plan, if somebody said, I want to buy 10 properties in 5 years. Let's talk about how we could actually do that. And say that this investor had available to them in year one, say that they had $60,000 available to them in year one. So in year one, if they use their existing $60,000, they could buy 2 properties. Now, be utilizing 65% mortgage finance that we have available in the U.S., they could actually buy 2 properties. Say going into year 2, if they could save money through the course of their their work, and even if they brought in a joint venture partner to assist them with this, they could do that as well. Say you could save another $50,000, buy 2 more houses, again with 65% leverage. In year 3, say you save $20,000, refinance the properties you bought from year 1 and buy 2 more properties. In year 4, save $25,000, refinance properties from year 2 and buy 2 more properties. And year 5, save $30,000, refinance properties from year 3 and buy 2 more properties. And really our philosophy has always been, right now everybody that's out there, a lot of our investors, they work hard throughout the day, and that's what we call active income. They're actively out there working to make money. Our goal for our investors is turn their active life into a passive income stream. And so what I mean by that is that you're out there working hard. When you're out there working hard, you need to be saving money, and you need to be putting into investments that actually provide a return both on cash flow and capital appreciation over the course of time. And real estate is one of the few assets that can actually do that. So what we do is we teach our investors how to utilize their active day jobs right now, plant that seed in the ground. That seed would be in real estate, and then utilize the power of real estate cash flow and appreciation and tax advantages to buy more properties. So here is what this plan could do for somebody based on today's market, and then look at it after 5 years. So if after the total of 5 years they invested $185,000, the portfolio cost is $1.270895, so $1,278,095. After 5 years, based on conservative projections, the portfolio value would be $1.456966, so $1,546,966. The 5-year cash flow would be $121,017, and the appreciation on those assets, based on conservative appreciation numbers, would be $276,000. In this case here, an individual's net worth increased by just under $400,000, and they have annual net cash flow of $41,000. So this just gives you just a quick snapshot as to how it could work for an individual investor. If we take a look at the overall spreadsheet as to how this all pulls together, there's a full financial model that's put together for our investors that's done on a customized basis for our investors to walk them through an overall real estate acquisition plan to achieve an ultimate goal of achieving a certain dollar value in income, as well as a certain portfolio value, and really allowing the appreciating assets to work for our investors to create positive net worth growth, as well as positive cash flow. Because what we're looking to do is we're looking to replace the investor's day job with passive income from real estate. Let's take a look at a property that we've got right now. Actually, this is in Oregon. This is one that we just purchased last week. And this one here is in Oregon Avenue in Phoenix. It was built in 2000. This one here is just over 1,600 square feet. It's a 4-bedroom, 2 bathrooms. Its peak price was $230,000. Replacement cost of this house today would be $205,000 based on current construction cost. We feel the normal market value on this property right now should be $174,000. The investor price, $99,950. The mortgage amount that you could pull on this house would be just under $65,000, leaving a down payment of just under $35,000. Now, when I talk about the prices, so let's talk about this just for a second. So when I talk about the replacement cost in relation to normal market value, traditionally over the last 30 years, on average, a resale house, so a used house, on average, would be about 85% the price of a new house. It's a traditional statistic. So a used house typically wouldn't be more money than a new house. I've only seen that twice in my 28-year career where that's actually happened. And it actually happened. I saw it happen in 2005 in Phoenix when everybody could get a mortgage. It put so much pressure on the housing stock that there was way more buyers than there was both used and new homes, that a used house became 104% the price of a new house, if you can believe that. It's not often that would happen, but it did happen then. But we don't think that would be a normal market. But typically, a used house on average would be 85% the price of a new house. So that's where we know where that normal market price should be. And right now you can see it's just a way overcorrected market. And if you look at your markets that you're in right now, whether you're in Montreal, you're in Toronto, you're in Winnipeg, Saskatoon, Calgary, Vancouver, take a look at the price of your houses. Can you buy a house in your market right now for $100,000 and rent that house out for $1,000 a month? My guess is probably not. Here in Calgary, the average price is just over $400,000, and on that house we could probably get $1,600 a month for rent. The numbers simply don't work. And when you add leverage to it, would you be in a positive cash flow situation if you use the power of leverage and you put on a 65% mortgage? No, it'd be very, very difficult for you to have a positive cash flowing asset. So we've got really a special opportunity right now where we can buy these undervalued assets. We talk about positive cash flow. We'll take a look at this particular house here. Annual income in this one is $11,400. Its annual expenses, which would include property management, insurance, property taxes, would be $2,232. Mortgage payments would be about $5,000 a year. You'd have net positive cash flow of about $4,100 per year, and the 10-year positive cash flow of this one, if you did a 10-year run rate, utilizing appreciation both for or escalating the cost for rent as well as your costs, you'd be about $60,000 is for your positive cash flow on that one. The appreciation expected on this property, if we look at both our internal and third-party statistics, with the original purchase price being $99,950, the projected 10-year value on this one is $142,260, leaving us an appreciation factor of about $42,310 on this particular asset. The principal reduction based on the lending terms that are available to us, if you start off with an initial mortgage amount of $64,968 and your mortgage after 10 years just over $56,000, you'd have principal reduction in the amount of $8,610. So that'd be the amount that came off your principal over the course of the 10 years. So a recap of performance for this particular property over 10 years with an original purchase price of $99,950, down payment $34,982, your net positive cash flow over 10 years just over $60,000. Your appreciation is anticipated to be just over $42,000. Principal reduction, $86,10. Your total pre-tax gain on this asset is about $110,943 with an original cash invested at $34,982. Your 10-year return is about 315% or an annualized ROI of 31.53%. Now, I think it's important that we put a couple disclaimers in here on this pro forma. This does not include sales costs and such as legal and real estate commissions. So if you sold the property after 10 years to pull this money out to realize these returns, it would be a little bit less because you'd have your legal costs and some real estate commissions. But if you didn't sell it and you kept it as a cash flowing asset, you just have a nice appreciating asset in a great area in Phoenix that's a very hand-selected investment grade property in a very specific area in this marketplace. So when we take a look at how can you actually participate with Arizona Investor, how can you get your money working for you? We've always said it's your money, you need to get it working for you. How can you actually make that happen? Well, the first thing to do would be to register with our client care division. If you work with one of our approved referral agents across Canada, you would talk to your referral agent about this program and you would get registered through him with our client care, with him or her, with our client care division. With our client care division, you discuss investment objectives. So they would go through and they talk about what exactly is it that you want to achieve. You know, down in Arizona right now, we have a lot of our buyers that are buying future retirement homes today or second homes today. The bulk of our investors are just straight investors. But really, what is your objective? Is your objective to buy one house? Is it two houses? Is it three? Is it 4, 5, 10, 20, 30? What is your objective? So we can actually design a plan that meets your objectives. The next step would be to go through financing pre-approval if you're going to put financing on the house. If you want to buy multiple properties and you want financing, we walk you through our pre-approval process with our American lenders. The next thing we would do is we'd walk you through the foreign tax consultation. Now, I got to tell you, I see a lot of Canadians every day that are making mistakes buying property in the U.S. because they're not getting the proper tax consultation done prior to making the purchase. So it's a very important step that we go through prior to you buying a property, and that would be the foreign tax consultation. It's extremely important that we go through that process. And then once you go through our process, now you're eligible to buy, and you can select from one of the properties that we have in inventory, or we bring in the inventory to meet your requirements. Obviously, go to contract, close on the property, and then repeat the transaction. Every month we do tours in Phoenix. We have one coming up towards the end of April. On April 28th, we have a tour coming up, as well as one on May 25th as well. And that's our foreclosure bus tour, and that's where you actually get to meet the ground team in Phoenix that makes it happen day in and day out. And so you get to meet our acquisition team. You get to meet a couple of our economists that are there. You get to meet our renovation team, and tour some great properties and see the whole team that makes it happen day in and day out. Also, we've got, if you sign up through our website, you can sign up for our Deal of the Week. And every week we send out our Deal of the Week. It's usually one of the assets that we just acquired. And you can see that as well. So you can see firsthand exactly the properties as they come available. The other thing you'll get access to when you sign up on our website, and that's www.arizonainvestor.com, you'll also get to be aware of upcoming webinars. So if we're doing a state of the real estate market in Phoenix, or the market that we're at, that happens to be Phoenix right now, you'll get the current statistics on what's happening with the marketplace, different trends that are taking place, different financing options, different types of tax structure options, things like that. So you can just be educated by coming on and joining our webinars and seeing exactly what exactly is going on. Before I break off this webinar, I'd like to go to the dashboard and see what we have coming in from our public that came in. So we've got a few questions I see that have come in from some of the people that have attended the webinar today, and I'd just like to maybe go through some of the questions that have come in and answer some of those questions. First question that came in from Mike, he said, how do you know that the market has bottomed in Phoenix? And that's a good question, Mike, and the answer to that is there's a couple things. The first thing is not the entire market hasn't bottomed. Prices of houses under $200,000, that market we feel has bottomed out, and our statistics show that because we watch the average price per square foot, we actually watch the average retail price, the median price, the average price, and you can see that that has bottomed under $200,000. The other reason how we know it's bottomed, and we've always said where will bottom be reached, because we bought houses all the way through the bottom end of the trough. And we always said that we always knew the bottom would be reached when an investor is able to step into the market and buy a house and get anywhere from a 6 to an 8% cash-on-cash yield using no leverage. And that's exactly what happened. It was 6.8%, and that's bottom because an investor will step in and buy an asset if it's a good deal, and he can realize a return between 6 and 8%, and that's exactly what happened. And so, we know market is at bottom under there, and what's actually happening right now is we're starting to come out of the bottom end of the pricing structure right now. So the people that actually step in right now, they're actually going to get an added benefit because they're buying right at the bottom just before we're starting to come out of the bottom of the curve. People that wait 12 months, it's not to say they're not going to get a good price in their property and some good cash flow. It just won't be as good as what they could have got 12 months before if they bought today. So that's a good question. Another question that came in from Sandra, it says, congrats, you're not selling books and CDs. This is the real thing. Well, Sandra, thanks very much. I know there's lots of people out there that sell books and tapes and CDs and these types of things. And no, this is the real deal. We've been in this market for many years. We've got a whole system set up. We're real estate investors ourselves, and our whole system, our whole team is built to provide real estate-based investment opportunities for investors. What most companies do that are out there is they sell books and tapes, and they sell what would be a theory. I know a guy in Phoenix that's a realtor, or I know of a property management company, and oh, and by the way, I've got a tax guy you can talk to too, and you can get all the information from me for $500. That's not what we do. Like, we're the real deal. We actually have our own inventory. We refurbish the inventory. We provide turnkey cash flowing assets from day one, property management in place for our investors. This is the real deal. We've got millions of dollars that we deploy on a regular basis, and that's committed to this Arizona Investor Program. No, we don't. We provide education free. It's all part of it, and it's all backed by our actual cash flowing assets that we sell. So, no, we're actually on the ground. We're actually making it happen day in, day out. We're not here to sell you a book and tape and say good luck. No, that's not who we are. We make it happen day in and day out. But thanks for that comment, Sandra. I appreciate that. Another question that came in that says, how do I handle foreign taxation? And that's a great question. John, thanks for bringing that in. And foreign taxation is extremely important, especially when you're investing in a foreign country. And so with our system, when you sign up and you go through your load-up system with our client care, you will go through a foreign taxation process. And I can't say it's the same for all investors. I can't say that John, you would have the same tax structure that say Mike would have, because it all depends on what your status is. Do you currently have investments in the U.S.? Do you want to buy one property? Do you want to buy two? Do you want to buy 5? Do you want to buy 10? Do you want to buy 20? For all those different scenarios would be different structures. You know, for the simplest way to own a house in Phoenix, the simplest way is typically to buy it in your own name or your name and your spouse's name. And how we do it in Arizona, and there's different types of ownership. And one of the most common ways that we do it is by utilizing the community property law, which is available in just a few states. And Arizona is one of the states that you can have community property ownership. And the most common way for an individual, or say a man and a wife that want to own a property, would be community property with rights to survivorship. That's the most basic way to own it if you're just going to own, say, one property. And that basically allows you to own the property, and if you passed on, it would automatically roll over to your spouse at full market value. And by doing that, you avoid the capital gains tax, as well as you avoid the cost of probate, because any asset that goes through a will in the U.S. that goes through the will process goes through probate. And it's a bit of a costly affair, but if you hold it under community property with rights to survivorship, you get a bypass on the probates. But again, I'm not a tax expert. It really goes back to an individual, and that's why we have our professionals in place that are specialists in providing tax advice for Canadians investing in the U.S. But great question, John, and that's all covered through our entire process. Next question that came in was, who handles property management? We do internally through our own management company, and that's handled directly by us, and that way we have full management on your property. Now, I have to tell you this, is that if you wanted to have somebody else manage your property, absolutely not a problem. If you want to manage the property on your own, which I think would probably be difficult for you, especially if you're living in Canada, you probably don't want to do that. You'd want to find somebody who's a professional in managing properties. The company that works with us, they've got just over 1,500 homes in management, and they have valley-wide coverage. And I've been working with them now for quite a few years, and we're getting strong rents. Vacancy rate, as you saw, is 2.75%. It has been under 3% for the last 2 years, and they just do a great job. So that's full property management. It's all taken care of for you. But again, if you want to have your own property management, and you're more than welcome to do that. Next question that came in said from Jason says, how do I get started? Jason, you can call the number on the screen, or you can go to info@arizonainvestor.com and feel welcome to contact them. A lot of our investors come through referral agents across Canada, and so if you do have a referral agent that's one of our approved referral agents, do contact them and let them know that you'd like to proceed, and they'll get you set up with the program. Another question that came in said, I've attended many seminars in investing in U.S. properties, and it seems like you guys really have this figured out. And again, thanks very much for that. Who that came in from, Jared. Thanks, Jared. I appreciate you coming in with that comment. And no, this is the real deal, and we're proud to have this going. Another question that came in said, how long do you think this opportunity will last? Based on the current, the 3-month and the 12-month run rates that we're seeing right now, based on the current supply that's coming through the pipe, the shadow inventory and demand, we think we've got about 8 months to buy, you know, at a really discounted level. The best opportunity is right now because we're coming out of the bottom end of the curve, and I can tell you that today the price of houses are more money than they were a month ago, and we see that trend going on for the next 12 months. So the sooner you step in, the better, because prices are coming up. But I see that you're going to be able to have a good buy opportunity in that market for about for about 12 months. But the sooner you step in, the better deal that you're going to get. We got another question that came in that said, can RSPs be used for investing in Arizona real estate? And the answer is yes. RSPs can be used for investing in Arizona real estate, and there's a process that you have to go through actually to make that happen. So what I want you to do is to contact client care, and they can get involved with you and walk you through that process. It is a little bit of a I'm not going to say a complicated process to go through. It's just a process you got to go through to make that happen. So I see there's a couple other questions that have come in, and there's more coming in. So just out of respect of everybody's time and being on time for everybody, I do want to cut it off here if I can. And these questions that came in, we'll respond to those via email just to make sure we get the direct answers. So I want to thank everybody for taking time to take some of your Saturday with Arizona Investor today and talk about how you can actually use your money to actually make money, invest in some great properties down in Phoenix, Arizona, and that's where we are active today. And just a couple closing comments. You know, you've heard it said before. You know, live where you want to live. So if you live in Calgary or Toronto or Montreal, live where you want to live, but invest where the numbers make sense, and we're firm believers in that. So on behalf of myself and our IT manager, Chad Butler, who puts this together for us day in, day out, and Kerry Smith, who does a great job in putting together these PowerPoints for us, I want to thank them, and most of all, thank you guys for coming on board. So on behalf of all of us at Arizona Investor, thank you very much for joining me today. Have a great day, and we look forward to connecting with you real soon. Take care. Thanks very much.